Hello students, we have seen the initial part of the chapter 8 about financial strength of a new venture project. Now we will be seeing the second part of the same chapter, understanding more about these ratios, how to assess a business performance, and what are some of the best methods to understand the financial well-being of a company. So let's continue. We will see what are the topics covered in this part of the video. One is profitability and liquidity ratios. Two, leverage ratios. Three, low, high, and healthy ratios. Four, efficiency ratio and inventory turnover. Five, assessing and calculating ratios. Six, four ways to assess the business performance. Seven signs your company has good financial health. So hope this will be very interesting to know and students will learn a lot from this part of the video. First, let's start with profitability ratios. These ratios are used not only to evaluate the financial viability of your business, but are essential in comparing your business to others in your industry. You can also look for trends in your company by comparing the ratios over a certain number of years. Net profit margin measures how much a company earns, usually after taxes, relative to its sales. A company with a higher profit margin than its competitor is usually more efficient, flexible, and able to take on new opportunities. So it's very simple. If you need to learn swimming, you need a pool bigger than your size so that you can just roam around and learn how to do swimming in shallow or deep waters. Similarly, if you want to try something new in life, you should have buffers and margins to succeed. It is not possible to have cut to cut monetary support in your business and then venture into it. And when you realize there are a lot of costs which were uncalculated or risks which were not foreseen, then you regret that why did you enter a business with such high capital requirement, or you fall short of the funds. And it is a really disappointing, demotivating moment. So better to have double than what you expect the cost to be and then plow in uncharted territories. Seeing the next slide, we will just summarize what we have done a bit from the previous video. Liquidity ratios. These measure the amount of liquidity, cash, and easily converted assets that you have to cover your debts and provide a broad overview of your financial health. So what is liquidity? We have understood. Next, we have to see what is current ratio. Basically, if you see the formula down, current ratio is equal to current assets upon current liabilities. But to know more, let's understand definition. The current ratio measures your company's ability to generate cash to meet your short-term financial commitments, also called the working capital ratio. So current ratio is also called working capital ratio. It is calculated by dividing your current assets such as cash, inventory and receivables by your current liabilities such as line of credit balance, payables, and current portion of long-term debts. The quick ratio measures your ability to access cash quickly to support immediate demands. Also known as the asset test, which we have seen before, the quick ratio divides current assets by current liabilities. Okay, we will proceed further with leverage ratios. These ratios provide an indication of the long-term solvency of a company and to what extent you are using long-term debt to support your business. Debt to equity and debt to asset ratios are used by bankers to see how your assets are financed, whether it comes from creditors or your own investments. For example, in general, a bank will consider a lower ratio to be a good indicator of your ability to repay your debts or take on additional debt to support new opportunities. So basically, why we are understanding all this with the perspective of banks, because in future, if loan is required or you need to mortgage your property or you need some assistance with finance, additionally to what you had envisioned, then of course, staying in the correct side of the bank requirements really help in the long run. So basically, bank will only give you loan if your credit is strong. And for this, you need to plan from before. Also understanding the formula of leverage ratio, let's see, it is total debt divided by total equity. Okay. So what is total debt by total equity? That means total loans and outstanding amount divided by total income and ownership of the company. So after understanding leverage ratios, let's go further to low or high ratio. How to know whether a ratio is too less or too much for my organization? Okay, a comparatively low ratio can mean that your company might have difficulty meeting your obligations and may not be able to take advantage of opportunities that require quick cash. Paying off your liabilities can improve this ratio. You may want to delay purchases or consider long-term borrowing to repay short-term debt. You may also want to review your credit policies with clients and possibly adjust them to collect receivables more quickly. So basically, borrowing and repaying your debts, short-term, long-term debts, everything comes in account when it comes to your credibility of the business. After seeing this, let's understand what is high ratio. A higher ratio may mean that your capital is being underutilized and could prompt you to invest more of your capital in projects that drive growth, such as innovation, product or service development, research and development, or international marketing. So that basically means that your capital is lying unused and you could invest more in maybe marketing or going in international markets or doing more research and development or improvising on the services given to the customers. After understanding this, let us understand what can be a basic healthy ratio. But what constitutes a healthy ratio varies from industry to industry. For example, a clothing store will have goods that quickly lose value because of changing fashion trends. Still, these goods are easily liquidated and have high turnover. As a result, small amounts of money continuously come in and go out. So basically, this business will be like that, that small amount of money will come in and come go, and easily the current ratio will be close to 1. Okay. Next, let's understand an airplane example. An airplane manufacturer has high value, non-perishable asset such as work in progress inventory, as well as extended receivable terms. So basically, it means that the asset is going to be very long term. Plus, there will be huge extension when it comes to credits, and it will not be instant payments and instant coming in and going out of the money the way cloth industry is, right? So businesses like these need carefully planned payment terms with customers. So the planning has to be extreme and there has to be a good calculation about profits and loss in this case. The current ratio should be much higher to allow for coverage of short-term liabilities. Next, let's understand what is efficiency ratios. Often measured over a 3 to 5 year period, these give additional insight into the areas of your business, such as collections, cash flow, and operational results. So, of course, efficiency does not clearly indicate in short term, but more usable in the long term. So, what it shows, how much is the total collection, the amount of cash that comes in and goes out, and what are the results of the processes that has happened in last 2 to 3 years. Inventory turnover looks at how long it takes for inventory to be sold and replaced during the year. It is calculated by dividing total purchases by average inventory in a given period. For most inventory reliant companies, this can be a make or break factor for success. So the companies which require to keep more inventories or more stock, this is very important. After all, the longer the inventory sits on your shelves, the more it costs because of maintenance, handling charges, and of course, removing the damaged goods. Going to the next slide, we talk a bit more about inventory turnover. Assessing your inventory turnover is important because gross profit is earned each time such turnover occurs. This ratio can enable you to see where you might improve your buying practices and inventory management. For example, you could analyze your purchasing patterns as well as your clients to determine ways to minimize the amount of inventory on hand. You might want to turn some of the obsolete or outdated inventory into cash by selling it off at a discount to specific clients. This ratio can also help you see if your levels are too low and you're missing out on sales opportunities. So basically, the idea is removing the junk, removing what's not required because they are actually a liability, and keeping up with things which are more usable and which will be an asset for the company in coming times. Because the more you keep an inventory, the more it becomes a headache to manage it and to sell it off. It looks old, packaging gets spoiled, so it's never wise to keep inventory more than actually required. Next, we talk about inventory to net working capital ratio, which can determine if you have too much of your working capital tied up in inventory. It is calculated by dividing inventory by total current assets. So, what we are understanding here is that net working capital ratio determines the working capital that is attached to inventory or locked due to the excess inventory. So, working capital is required on daily basis, and if it is locked in inventory, it can cause problems. In general, the lower the ratio, the better. Improving this ratio will allow you to invest more working capital in growth driven projects such as export development, research and development, and marketing. Understanding evaluating inventory ratios a bit more to get a better idea. Evaluating inventory ratios depends a great deal on the industry and the quality of the inventory. Ask yourself, are your goods seasonal, such as sky equipment, perishable food, or prone to become obsolete fashion? Depending on the answer, these ratios will vary a great deal. Still, regardless of the industry, inventory ratios can help you improve your business efficiency. Average collection period looks at the average number of days customers take to pay for your products or services. It is calculated by dividing receivables by total sales and multiplying by 365. To improve how quickly you collect payments, you may want to establish clearer credit policies and set collection procedures. Of course, if the payments are stuck, it is a liability for the company. And then you will have to extort it out of the people who are not paying on time. And then it becomes more complicated if they're not willing to pay it. So you will have to employ people who will just do the collections and they will be after these people. So these things have to be kept in mind that the payments keep coming and going out in time. For example, to encourage the clients to pay on time, one can give incentives, that is bonus or extra discounts, offers, schemes, or if they pay quickly, you can give a huge concession or discounts. You should also compare the policies of those industries to ensure that the discount or offers you are paying to reduce the bad dates are competitive and are as per the industry standards rather than being at a loss or not matching what others are not doing. Okay, let's see what is operating profit margin. Operating profit margin, also known as coverage ratio, measures earnings before interests and taxes. The results can be quite different from the net profit margin due to the impact of interest and tax expenses. By analyzing this margin, you can better assess your ability to expand your business through additional debt or other investments. Return on assets ratio tells how well management is utilizing the company's various resources or assets. It is calculated by dividing net profit before taxes to total assets. So basically what it is, net profit by total assets, but net profit is gross profits, okay, minus taxes, that is net profit. The number will vary widely across different industries. Capital intensive industries such as railways will yield a low return on assets since they need expensive infrastructure to do business. Service based operations such as consulting firms will have a high ROA as they require minimal hard assets to operate. Next, we will talk about return on equity. Return on equity measures how well the business is doing in relation to the investment made by its shareholders. It tells the shareholders how much the company is earning for each of their invested dollars. It is calculated by dividing a company's earning after taxes by the total shareholders' equity. So how it is calculated? Return on equity is equal to company's total earnings after taxes, that is after reducing the amount of taxes required, by the total shareholders' equity and multiplying the result by 100%. A common analysis tool for profitability ratios is cross-sectional analysis. Just doing an overview of this cross-sectional analysis, we will not get into details, which compares ratios of several companies from the same industry. For instance, your business may have experienced a downturn in its net profit margin of 10% over the last 3 years, which may seem worrying. However, if your competitors have experienced an average downturn of 21%, your business is performing relatively well. Nonetheless, you will still need to analyze the underlying data to establish the cause of the downturn and create solutions for improvement. So there is a chance that if you turn tables, if you make it turn better, you will get some warning from before because of calculating this ratio. Again, we see the formula well written. ROE is equal to net income annually, full year, above shareholders' equity. Assessing and calculating ratios. Since we have seen so many ratios, let us understand a bit more how to calculate and understand with perspective of globally what people are doing. To determine the ratios, one can use a variety of online tools such as BDC's ratio calculators, or maybe SPSS, or maybe even Excel sheets. Although the financial advisor or accountant or banker may already have the most currently used ratios on hand, they may be experts in how to calculate these ratios. Of course, keeping lawyers and bankers, accountants, etc. for your business handy who will be helpful and in assisting is a great advantage to any business, because these service providers, if they are trustworthy, they will give you the correct ratios, they will give you the correct counseling also in the process, how to calculate how your company is going or in which direction you should go if your ratios are not matching the requirement of the India's industry standards. So for a fee, industry standard data is available from a variety of sources, both printed and online, including Dun& Bradstreet's industry norms, key business ratios, RMS annual statement studies, and statistics from Canada, search for financial performance indicators for Canadian businesses. So if you see, every country has their own ways of calculating ratios. Again, interpreting the ratios will vary from industry to industry, as we already know. And of course, it requires great knowledge of the business, about the industry, reasons for fluctuations. In this light, BDC experts offer sound advice which can help someone to interpret and improve the financial performance. What is beyond the numbers? It's important to keep in mind that ratios are only one way to determine the financial performance. Beyond what industry a company is in, location can also be important. Regional differences in factors such as labor or shipping costs may also affect the result and the significance of a ratio. Sound financial analysis always entails closely examining the data used to establish the ratios as well as assessing the circumstances that resulted in such ratios. Coming to our next topic, 4 ways to assess the business performance. Let's ponder on these ways and see how it helps to assess our business better. First, look at the business financial statements. Second, check customer satisfaction and average how many new customers one can get and what are the costs in getting these new customers. Third, conduct performance reviews and assess own expectations. And fourth, stay current on the market. So these are the 4 techniques which helps to assess the business performance. And I hope students till now you have understood the importance of all these methods. And the last 2 points talks about continuously taking feedback and sitting and reviewing what is the position of the business. Of course, the expectations of an entrepreneur will be much higher than what is actually achieved most of the times. So these expectations have to match the reality and it will help to come to the real situation or to go to the root cause analysis of a conflict or a problem or a crisis. And of course, understanding your competitors, staying current on the market is equally essential. Going to the next slide, 7 signs your company has good financial health. It's somewhat easy to determine if your company is doing well, so you will be in the black every month, able to make your payroll and pay all your monthly bills and expenses. But are these discernible levels or observable distinctions that reliably signify good financial health? Or are there ways to determine how well you are doing beyond the norm? There are more than a few ways, some of which may be more appropriate for your business than others. With that in mind, let's review 7 signs that your company is in good financial health. 1. Your revenue is growing. When looking at your profit and loss statement, you should be able to see a pretty steady increase or a consistent improvement in the revenue month after month, year over year. It doesn't have to be a huge growth in profits, but it can be an increase by a couple of percentage quarterly. So maybe from January, February, March, if you compare the previous year, Jan, Feb, March, maybe the growth is 5% or 10%. Why quarterly? Because most of the products are seasonal or have their ups and low times in the market. So for example, umbrellas sell more in the rainy season or summer clothes sell more in the summers and woolen wear sells more in the winters. And this applies to most of the businesses apart from maybe essentials. So it is important to compare quarterly analysis. And usually, according to financial accounting year, the quarters are Jan, Feb, March, second quarter or first quarter can start from 1st April. So April, May, June, and then July, August, September can be the second quarter. October, November, December is the third quarter. And then again, Jan, Feb, March is the fourth quarter. So increase in this couple of percentage shows upward movement and a strong financial outlook. Next, your expenses are staying flat. In conjunction with your revenue growing, you want your expenses to stay flat. If your business experiences a significant growth spurt, then your expenses may rise. But in general, this increase should be in line with your increase in revenue. So, if your revenue is increasing 3% year over year, you'd want your expenses to increase no more than 3% during the same time frame. Let's go to the next point. which is your cash balance demonstrates positive long-term growth. So our third point talks about while you may be increasing your revenue, if you are taking that money and simply investing it back into the business, you might find yourself asset rich and cash poor. So there has to be a healthy balance between the money you are putting in the assets and between the cash that you are drawing and keeping for yourself or working capital. A low or stagnant cash balance means your business is not sustainable. You want to keep a healthy amount of cash in the bank so that if anything urgent comes up, you aren't in a position of having to incur more debt to meet an unexpected expense. In business, it's highly chances there are high chances that you might need to pay unexpected places, like you want to buy more products, you want to add more employees, you need to increase a service, you need to spread centralized system across the branches, or you might need to increase the legal charges or accounting charges, or you want to add delivery vehicles. It can be anything. So, for such unexpected expenses, if there is no cash or a quick available liquidity, it can mean harm to the business. And there is no one who will be waiting for cash apart from the regular creditors and debtors. So you can't ask for, time from anyone and everyone. Coming to our next point is your debt ratios should be low. After understanding about debt, equity ratio, etc., I think this is very clear. But just to give a summary, there are two debt ratios to pay particular attention to: a business debt to asset ratio and its debt to equity ratio, also referred to as solvency ratios. So, debt ratios are also called solvency ratios. These formulas specifically measure how much your business owes versus how much your business is worth. As with most ratios, a lower number is ideal. And for the debt to asset ratios, maintaining a 2:1 ratio or lower is preferable. Going to the next slide, your profitability ratio is on the healthy side. There are a handful of profitability ratios that measure the return on your sales and investments. One of the best ratios to measure is your profit margin. This involves taking your annual net profits and dividing it by your annual sales. So while you may be making sales, your profit margin could still be low depending on your pricing structure, startup costs, or other factors. Your profitability ratio is considered healthy when it's on the high side. Going to the next slide, your activity ratios are in line. There are a few different activity ratios that measure how your business manages its assets. Three of the common ones are asset turnover. This formula takes your sales and divides it by your assets. A high turnover ratio translates to more efficient asset management. Okay, some more jargons which are important and we have covered it before, but to just highlight them: inventory turnover, which is the cost of sales divided by average inventory. A high inventory turnover ratio means you're efficiently managing your inventory. And next, operating expense ratio. For this formula, take your operating expenses and divide it by total revenue. I hope students are jotting down these formulas and they will be very useful in the long run. This measures how much you spend in order to generate revenues. In this instance, a lower ratio shows better efficiency. That means you are spending less and you are getting more revenue. So please don't forget the inventory turnover and the operating expense ratio. Both are very good indicators of efficiency of the startup or the business. After this, we will be coming to the last part of this chapter where we will be concluding what we have learned and just understanding that how these ratios cannot be avoided in a business. So better to know a bit more about them. And the last point, you are working with new clients and repeat customers. Of course, loyal base of client which business does not want. and a customer to come back, which business does not want? And like we know very well that bringing the same customer back is less costly and easier if he is happy than getting a completely new, fresh prospective client. That can be more costly when it comes to marketing. So, if this is there in the business, that means it is definitely bound to grow. So, the cost to acquire new clients is higher than the cost to work with the same customers over and over again. A steady stream of new clients and repeat customers demonstrates that your business has multiple options for generating revenue. By having access to new customers, one can help to insulate the business from changing attitudes and buying patterns. Continued, measuring the health of the business finances can be as simple as reviewing a profit and loss statement, or as complicated as analyzing all the different elements of the business. However, there is very little doubt that fully understanding the business finances is a sure way to remain successful and profitable. Of course, the more we understand these things, the more we can be assured that we know our ratios well and our business stays healthy. The complications reduce for any kind of business if the profit and loss statement is in control. Thank you so much, students. Hope you learned a lot about the financial health of a business. For any other doubts, our further chapters will clear about more about understanding about startup financial strength. Please continue watching our next chapters to understand the entire subject properly. Thank you.